Welcome to this update on the hedged option portfolio. Since the previous update, Bitcoin has set a new all-time high of 112k, then pulled back to around 100k, and now sits at around 107k. So a decent amount of price movement, but both accounts, which are both normally short volatility, are both doing well, both up since the previous video. As always, for a real-time look at the performance and the positions in both accounts, you can find me on the Greeks Live social page, which I will add a link to in the video description. Despite flirting with new highs several times, a big breakout has failed to materialize so far, and implied volatility is very low. Devol, for example, which tracks 30-day implied volatility, is sitting at yearly lows, with IV rank and IV percentile both under 1. In fact, one of the reasons that I'm doing this video on a Thursday instead of the more usual Wednesday is because the vol levels are so low at the moment, with short-dated vol in the 30s, which you can see here. This meant that on Monday, the prices of the Wednesday options, which I would normally be selling on a Monday, were getting a bit low for my liking, so I went out an extra day to Thursday instead. The reason lower option prices matter is that the lower the option price, the greater the percentage of the premium the trading fees become. This percentage is thankfully capped at 12.5% of the premium on Deribit, no matter how small the premium, but I still prefer the fees to be a smaller percentage of my maximum potential profit, as then there is a bit more wiggle room for me to be wrong. The numbers in this example are hypothetical, but for example, I don't want to be selling an option that I think is on average overpriced by roughly 10% if the fee I'm paying is 10% of the option premium that I'm collecting. All my theoretical profit would eventually end up spent on fees, so there's no point in me taking that trade at all. I'd much rather sell a more expensive option that I also think is overpriced by 10%, but where the fee is then only, say, 5% of the premium collected. As a quick example, assuming the standard 3 basis point fee, if I sell an option at 30 basis points that I think is only worth, say, 27 basis points, I'm paying all of my theoretical profit in fees. However, if I sell an option at 60 basis points that I think is worth 54, I'm still making a theoretical profit after fees, despite both options being overpriced by the same percentage. Again, these numbers are just made up, but the point I'm making is the lower the option price, the more I care about the fees. So I had positions expiring in both accounts this morning, which is a Thursday, meaning I've got trades to execute in both accounts today. So I'm in the main account here, where I hedge with longer dated options. And at the moment, the delta is sitting at 0.15, so plenty of positive delta. In fact, I could lower that delta a bit. The theta's a bit low at 30. So the way to lower my delta a bit but increase the theta is to sell a call. So I'm going to go 2 days out, which is the 14th, and sell a call option. Current price is about 107,500, and I'd be looking at probably the 108 here. You can see the vol's pretty low here. We're in the mid-30s. And there we go, that filled. It was a couple of basis points below the mark, so that's not surprising. And if we scroll down again, we can see the delta's reduced from 0.15 to 0.11, and the theta has increased from roughly 30 up to 60. You'll also notice my long option positions, which is my protection in the June expiry, is now all basically worthless. And that's because the June expiry is now in a couple of weeks, so all these very out-of-the-money options are worthless. So I've already begun and will continue to place more protection in the longer dated expiries. You can see I've even got one put all the way out in March next year now. There's no rush on doing this. I've got plenty of protection in September and a little bit in December, and I'll continue to add to these as I'm selling more of the short dated stuff. So that's the main account looking fine for now. If I head over to the Delta Hedged account, I'm only doing one position in this account at a time, and as I had positions expiring this morning, I now have no positions in this account at all. So what I'm going to do is sell both a call and a put in this account, and that will of course be automatically hedged by the Greeks Live Auto DDH tool. And I'm going to do the execution in this account via the Maker Assistant tool as well. So I want the 14th of June expiry. I'm going to sell the 107k put, size of 0.1. Based on the mark price, add a tiny bit. And the same for the 108k call. Remembering to change the size to 0.1. Add that leg and then send both of these. You can see we got filled on the put side there. And we've got filled on the call side as well. And you can see the delta hedging tool is stepping in and starting to hedge the delta as well. That just took a minute or two to get filled on all of those. So both accounts sitting how I like them at the moment. And I'll wait for those positions to expire and then I'll add more as usual. That's it for today's video. Thanks for watching and I'll see you next time.